This is a progressive tax, meaning certain buckets of money will be taxed at different rates depending on how much you make. And so there's a table for that. But this here is pretty much fixed. This is 15.3%. Let's say you made 100,000 as an example, 100K. You're gonna pay federal taxes on that. I don't know exactly how much the federal tax is because you're gonna have deductions, either standard deduction, itemized, qualified business income. You have all these deductions. So this is a little bit harder to calculate, but this one is super easy because you take 100K, multiply it by 15.3%, and now you owe $15,300 in self-employment tax or Medicare and Social Security tax. This is really unavoidable under a Schedule C. Here's the thing. Once you get to a certain point, let's say about 100K, this is where it starts making more sense to jump from a sole proprietor into an S Corp. And here's why. The way you want to think about yourself in an S Corp is you're going to perform two functions. You're going to be an officer, and then you're also going to be a shareholder. As an officer of the company, you're going to get something called wages, W-2 compensation. What you need to do is you need to pay yourself something called reasonable compensation. And that varies, number of years of experience, total revenues, total profit. It's a lot of factors that can influence this. And in your W-2 wages, of course, you're going to pay all these three taxes. But here's the amazing part, is that also as a shareholder, your company is going to make some profits, right? After paying yourself W-2 wages, after paying other agents, after paying your office, after paying everything, there's going to be a net amount, a net profit. And that net profit is going to flow to you